Hello, Phoenix. This is Lawrence Yun, Chief Economist with National Association of Realtors. Certainly, the market condition has changed, or I should say the whole country is trying to adapt to this once-in-a-lifetime, hopefully, not more than that, scenario of the virus impacting, leading to health concerns, as well as economic shutdown. Given this environment, it is very difficult to see how everything will play out. Maybe the most positive news is that some form of vaccine is quickly discovered, so we are back to normal. Or maybe we have the economic shutdown. Essentially, this is a government-imposed economic shutdown of not going to restaurants, the travel restrictions, and such, which impacts roughly 10 to 15% of the employment right off the top. And negative news can fit on negative news. But we hope that the stimulus package, the massive $2.2 trillion stimulus package, will lead to some income stabilization and the basis for economic recovery. The Federal Reserve also at the same time is providing liquidity to assure that there is no hiccup in the mortgage lending process. So with that introduction, I will try to give you quickly how I see the market could play out and why in the most optimistic scenario, the 2020 home sales overall may be neutral compared to 2019. We will be hit in in March data, April, possibly into May. So we are losing that spring buying season, but with a strong recovery, all those lost sales could be easily made up in the second half of the year, provided all the good stuff line up in the right way. So let me give you how the market conditions with some solid economic data. And I hope I am able to move these slides. So let me see here. Okay, there we go. All right, so economy was actually in a very good state before the coronavirus hit, running at close to 3% in 2018, 2.5% in 2019, and 2020 was going to be quite a good year in my view, possibly another 3% GDP growth. But of course, I put a big question mark because overall GDP growth could be slightly negative. I don't think it will be a big Great Recession of housing foreclosures that we saw 10 years ago. But the depth of the recession, well, it all depends on how the virus situation plays out. But we are not in trouble related to the housing market because going into 2020, the real estate was on very solid ground. That is to say that we did not have overbuilding, oversupply, and hence inventory situation will be very well managed. And second, any mortgage default related will be due to job losses and not due to some adjustable rate mortgages changing from subprime lending. We don't have subprime lending. Most people have to meet the more tighter credit score requirement. And therefore, the housing market was actually on a very solid footing. 2020 GDP growth completely unknown at the moment, other than second quarter numbers will be quite ugly. But whether third and fourth quarter can make up for those losses in the second quarter. Moving into the next slide, shows the job market condition in the Phoenix metro market. Again, very healthy condition before the virus impact. In fact, Phoenix job situation were easily outpacing the nation by more than twice as fast. So there was a little up and down during 10 years ago when there was an overproduction activity in the Phoenix area, a lot of construction activity. And then there was the decline because it was unsustainable with the subprime lending. But now the job market and the housing market has been moving in a similar fashion because now we are on a very solid footing. But the job losses, there will be some degree of job losses in Phoenix, just as in every state. When the nation goes into economic recession, nearly every state follows some degree to that. But overall, Phoenix market is showing better condition compared to the rest of the nation. The University of Michigan consumer sentiment data that came out in mid-March, I was quite surprised by this because early part of the March, there was a heavy discussion about the virus, needing for social distance, many places where it was not essential to say that work from home edicts coming out from the government. Yet despite all of that condition, the consumer sentiment actually did not actually decline all that much. Maybe towards the latter part of March, we will see more notable impact, but this is quite surprising. The consumer sentiment remained quite healthy even as of mid-March. The home sales in the meantime has been running steadily higher. We are nowhere near the peak home sales activity of 2005, and good thing, because we don't want to have a return to that easy bubble, artificially inflated home sales. So these are solid movement in home sales along with following the job market conditions. Inventory has been extremely low. That was one hindrance to the market recovery. One thing that I hear in the month of March is that some home sellers are delisting their property and trying to wait out until the coronavirus is out of the way. That means that we may actually have even tighter inventory condition for a few months, certainly lower inventory than what it could be in the absence of the virus. But this is just a testament that we don't have oversupply. We have a very manageable inventory. Of course, the demand will be weaker for the few months, but I think this is just saying that let's pause for a second, and once we get all clear signal from the government, then there could be a robust rebound in inventory as well as in the home sales. The Federal Reserve, as I mentioned, is all accommodated. Back in 2008, which by the way was a presidential election year, the Federal Reserve took 7 rounds over several months to reduce interest rate down to 0, the Fed funds rate down to 0. This time around, the Federal Reserve is saying we're not going to play that long game. We're going to go all in, all once. So they reduced the Fed funds rate to 0 and also announced something called quantitative easing, and wait for the realtors to understand that is just to keep the long-term interest rate, like mortgage interest rates, very low. Commercial mortgage-backed securities is running into some problems because it doesn't have government backing, but the Federal Reserve is trying to assure that they will also purchase some of the commercial mortgage-backed securities if it has very solid underlying collaterals. So in the meantime, the mortgage rates, week to week, there's little bounces. My guess is that there's more room to go down. The spread between 10-year Treasury, which is the red line, and the 30-year fixed rate mortgage, which is the blue line, they move almost one-to-one lockstep. But right now, the spread between the two is much larger than usual. So I think the mortgage rate may actually be able to go down to close to 3% based on what I am seeing. So maybe hopefully there will be additional enticement for home buyers to get ready once we get the all clear signal. We take survey of realtors just asking about the buyer traffic conditions. Interestingly, neighboring state Nevada, maybe they are too reliant on tourism. We know that Las Vegas is completely empty. A lot of jobs related to that industry. Hence, loss in Nevada showing that weaker traffic condition. This data is as of February, so it's not truly coronavirus impact as of yet, but Arizona is showing very solid condition for going into the coronavirus. Now, home builders would be the key to inventory condition, but you see a multiple years of being under the red line, which means underproduction. Below the historical average. past couple of months, the home builders have produced a little bit more than normal. There is no concern for oversupply given the number of years of being underproduced. So maybe this was a signal that the Phoenix metro market will see a little more inventory in 2020. But for a few months, home sellers are either delisting or postponing the listing until the virus situation is out of the way. So the inventory situation, again, the bottom line is we will not have an oversupply situation. This is a positive news for the long haul. I know that we're going to be at the end of this virus, hopefully within 6 months, but maybe it's within a year. But however we view it, I believe the next 5 years, Phoenix market is well situated to benefit from this huge pent-up demand. And what do I mean by pent-up demand? We just have to compare the recently completed year with the year 2000. And what you notice is that affordability condition is actually better now than in the year 2000. Home prices are certainly higher, but also people's income. But the second line, lower mortgage rate has greatly improved the overall affordability conditions. Population, many people are going to Sunbelt states like Arizona, but overall U.S. population is about 50 million more people living in the country. Adult population, 16 and over, also very similar, much larger number now than before. Households, families, 20 million more people living in the country. Jobs, 20 million more. So given that we have more people with jobs, better affordability condition, what about home sales? Well, in 2019, many people are calling a decent year, yet it is below year 2000 levels. And 2000 was not a bubble year, artificially high year. It was a very normal year. So if it was underperforming in 2019, which I attribute to inventory shortage, that we have plenty of room to grow. So I say to the large brokers that as you plan about your business activity for the next 5 years, probably 4 of those 5 years will be an improving year because of this large pent-up demand. Some places will have better performance. Arizona would be one. Texas would be another. Florida another, because the population trend is faster growth in the southern Sunbelt states compared to other northern states. So I think the Arizona as well as Phoenix market will participate in this huge pent-up demand growth. I just did not realize, I always say 4 out of 5 years because I just give 1 year as a caveat. I didn't realize that 2020 could be that caveat year with this external shock impact of the economic shutdown from the virus. So the forecast that I originally had was no recession, job growth, everything just running nicely. Only concern was some trade war with China, trade war with Canada and Mexico. But President Trump signed a trade agreement with Canada and Mexico in December, as well as phase 1 trade agreement with China. So I thought that 2020 would be a very good year. But then we have trade restriction just coming because of the virus, that there will be less international trade, not because of government policy, but because of the virus. And also the home forecast before the virus, the pent-up demand said about 10% growth in new home sales, 4% growth in existing home sales, prices rising comfortably, maybe 4%, mortgage rate to be under 4%. Very nice forecast. But everything has been thrown off because of the coronavirus. And when we take survey of realtors, they are saying they are seeing less buyer interest. And I think this is partly caution. Also, some people have lost wealth in their stock market, but they will not lose wealth in real estate. Real estate values are holding on. Also, a survey on the sellers showing some delisting impact. We think that this is all temporary. And those delistings are being classified in the MLS as temporary off market, which means soon as the market condition or the government gives an all okay signal, that this listing will quickly get back onto the market. So my final slide on the forecast is, I think one has to be admitted, it is highly uncertain. Maybe we get economic recession, -1%, -2%, or maybe we don't get a recession with a very strong, robust activity in the second half. Job situation, again, similarly, very uncertain. But one thing that can be assured is that housing is on a very solid ground. I don't see any major decline in home prices, especially with a stimulus in place and the very accommodating monetary policy. I know it's tough. Just hang in there. And I know the market will get better. I just don't know whether it's going to be 2 or 3 months from now or 5 or 6 months from now, but we will see better conditions ahead. Housing is in good condition. Some of you I know own real estate investment properties. Those property values should hold on overall. So it's not the case of 10 years ago. So I wish you best in your business and stay safe during this highly uncertain time. Thank you.